Hello and welcome to Consumer Education. Some quick announcements before we begin. First things first, there's going to be 2 to 3 grades a week. First one's going to be a module grade, so complete Module 1, Banking Basics, for this week. Second is going to be a Google Quiz grade. That'll mainly focus on the content so that way you're remembering what is being shown in these videos. And third, it's going to be a writing grade, so that way you can be properly prepared for your next year of high school or college or whatever you choose to do in your life. I'm going to make at least one video a week, might make more to reduce the lengths of them, so that way you're not watching an hour-long video, and maybe a clarification video here or there based on the Google Hangouts questions. We are taking attendance via engagement. Now, what does engagement mean? That could mean contacting the teacher, whether it's messaging me, commenting on a YouTube video on Google Classroom, or office hours returning an assignment. Then we will mark your attendance. Also, get your friends to sign up for consumer education. This is a requirement to graduate, and it's also important just for life. You should know how to handle your finances. We're going to focus on accounts for today. Your objective is to write evidence-based arguments about the types of accounts that also addresses counter-arguments. You will be able to describe the different types of accounts as well. Your two objectives. The pre-AP skill is evidence-based writing. So ponder this. No need to write it down. This is the equivalent of a bell ringer. Also say hi to the doggy. What are the different types of accounts that a bank will let you have? Well, there's many different types of accounts, but we're going to focus on 4. Savings, checking, money market, and certificate of deposit. We are going to touch on checking, but we're not going to spend too much time on it. Here's some vocab you're going to need to understand some of this lesson. Interest refers to two related but very distinct concepts. Either the amount a borrower pays the bank for the cost of lending or the amount an account holder receives for the favor of leaving money with the bank. So in finance, interest comes up in 2 cases. One is when you take out a loan from a bank, when they lend you money. When they lend you money, they expect you to pay them back with interest, which means that if they give you a $500 loan at X amount of interest, they expect you to pay $500 plus whatever interest they charge you. Also, banks will give you interest for leaving money with them. So let's say you leave $10,000, they might give you 1% interest per month, per year, depending on how it is calculated. And liquid, how easily you could turn something into cash. So checking accounts are very liquid. I can go there, take money out, and then use it to buy something in cash. But real estate is not. First, I would have to put the house in the market, make sure it's up to code, get it inspected, and then when I do sell it, I would need to go through lawyers to make sure it's set up, and then finalize the agreement. It takes a very long time, so real estate's not very liquid. And deposit is just how much money you place in your account. Now let's move on to checking accounts. Something that's very distinct about checking accounts compared to other types is there is no limit to how often you can withdraw money. You could withdraw it 100 times in a single day if you really want to. The only thing limiting you is how much money you have in your account. Savings accounts, money market accounts do put limits on how much you could take out. And they usually come with checks or an ATM card or a debit card. So you don't always have to carry cash. Instead, you put your card in, you put in your PIN number, and then it's approved. That's usually linked to your checking accounts. But they typically have lower interest rates than saving or money market accounts. So do keep that in mind. So your money is not going to grow very quickly in a checking account comparatively. Checking accounts. Some come with monthly maintenance fees. So, at a large bank, it could be $15 a month, but oftentimes banks will waive the fee if you reach a certain minimum threshold or if you continuously add money to the account. So make sure you read the fine print before you open an account with a certain bank. And overdraft fees. These are charged when you spend more than you have in your account and choose to enroll in a feature called overdraft protection. These fees can be expensive. The median overdraft fees at large banks is over $35. So basically, this is spending money you don't have. So let's say you have $3 in your account and you want to buy a $5 pizza at Little Caesars. Well, that results in you going above the amount you have in your account, and the bank charges you an additional, it says $35 here, in order to give you that extra $2 for that pizza. Now keep in mind, sometimes this may be smaller, sometimes it may be higher, but you don't want to spend more money than you have, otherwise you'll have even less. Types of accounts. Savings account. This is an account where you save for big purchases and you want quick access to your money. Usually no minimum to open, so you can open a savings account with $0 at most banks. I also want to be clear with what does quick access to your money mean. It means that you can take your money without issue. Now you may be thinking, wait, why should it be a problem for me to access my own money? Well, for some accounts, as you'll see later on, you cannot access your money quickly without penalty, or if you do try to access it before a certain time, there will be a fee. Now, the only time you'll ever get a fee is if you ever make more than 6 withdrawals per month on a savings account. So if you withdraw 6 times, that's good. There's nothing charged to you. If you withdraw 7 times, there is going to be a penalty. So they might charge you an extra $10 or $20 for taking it out a 7th time. In addition to this, they might charge you per extra with transaction. So maybe they'll charge you $10 per transaction as 6. The next type of account, this is a type of savings account, but it's a high interest savings account. Now the only difference here is that it has higher interest, and it typically requires a higher minimum deposit. So not necessarily 0, but maybe $100, maybe $200, maybe $1,000. There are more maintenance fees, but there's also a higher interest rate, significantly higher interest rate usually. So when you get more money, you might want to transition to a higher interest savings account. And again, still limited to 6 withdrawals per month and still insured up to $250,000. Types of accounts, certificate of deposits. So earlier, I said the benefit of savings accounts was that you had quick access to your money. And that's a benefit because of accounts like CDs, where you put money into an account that can't be touched for a certain amount of time, anywhere from 3 months to 10 years, whatever you decide. And if done so, there is a penalty. Now you might be asking, well, if I don't have quick access to my money, why would I want a CD? And that's because of the interest rate, because usually and generally speaking, CDs have a higher interest rates than savings accounts and money market accounts. And so the cost of getting more money is that you can't access your money very quickly. And so typically speaking, the longer the amount of time that you allow the bank to hold on to your money, the higher the interest. And this is known as a traditional CD. There are like 12, 13 types of CDs out there. So I'm not going to go over them. But this is your typical traditional standard certificate of deposit. Types of account, MMA, money marketing account, or an MMA. So for this account, a minimum balance is required. And in return, you get a higher rate of interest than a savings, but less than a CD. You can add and take money as long as a minimum balance is met. You receive a debit card, and you get access to it 6 times. So you might think, why might I want a money marketing account over a savings account? Now, money marketing accounts typically offer higher interest than savings accounts, and because of that, they require a higher initial deposit. So if you have enough money, you might want to transition from savings to money marketing accounts. So it's a way for you to grow your money quicker. And it's also kind of a combination between checking and a savings, in the sense that you do get a debit card that you can use to spend on things. Now keep in mind, this should be used for bigger purchases, as you can only withdraw 6 times a month before you get a penalty from it. And one thing I also want to bring up, though, that you might see is a money market fund. This is similar to an MMA, but they can invest the money and possibly lose some of it. It's higher interest, but it's not FDIC insured. So a money marketing fund, they will grow your money a little bit higher than a money market account because they can invest it, but they could also possibly lose it. Now keep in mind that there's a very low chance you'll lose your money, but there is still a chance. I think the biggest flaw with this is that it is not FDIC insured, which means that if the bank goes under, then you just lose all your money in the money market fund. So now let's talk about the purposes of these accounts. So the purpose of a savings account: your money is quickly accessible, and it combats inflation with low interest. Inflation on average is 2 to 3% per year. So your money actually devalues with time. And so a savings account helps reduce that. It's better than putting your money in the closet. And it's meant to be used just in case or for emergency funds. So let's say your car breaks down. Let's say you need to pay for a hospital bill or pay a vet bill for your pet. Well, you could have it there to access to pay for this emergency that came up. It keeps your money safe. You can also reinvest it later. And again, make sure it's FDIC insured. You need to make sure it's insured. If it's not, you're at risk of just losing your money flat out. Certificate of deposit: you give a bank money for them to invest for a set amount of time. So part of the reason they don't want you to touch that certificate of deposit is that that money they use to actively invest in order to gain a profit, in order to give you a piece of that profit, and for the form of interest. This is a high balance minimum, and you should only use this again if you want guaranteed money and you won't need that money back during that time period. A 5-year CD may be appealing because of a higher interest rate, but keep in mind and think about where you were 5 years ago. 5 years is an extremely long time. 5 years ago, Obama was still president. So do keep that in mind. The time period matters, and whether or not you'll need that money, the time period matters. We went over mixed marketing accounts, so we have no need to really stay here. So what I want you guys to do is I want you guys to read these 3 articles: high interest savings accounts, certificate of deposit, money market accounts, and then answer this question that's due by Friday. What is the best type of account to make? A savings, money market, or certificate of deposit account? Write me a paragraph that addresses counter arguments. Use evidence from the article to support your answers. It'll be graded according to rubric 12.1a. Since it is only a paragraph, it'll be graded harsher than I have graded your essays in the past. I'm going to make a separate video about how to write that because this video has gone on long enough. And your evidence right here could all be used. Also some things. Do Module 1 on EverFi, the financial literacy one. Do the one about banking basics. And also do the Google Classroom quiz. So again, the module on EverFi, 9510, Log on here. So I already completed it before, but I'll show you. Load in. So you're going to do banking basics. So you can retake the quiz. So notice, got a 90%. You can retake it as many times as you want until you get 100%, and I will take the highest score you get.
In this module...
Oh, that's loud.
Let's play...
Frick. So as you can see, it takes you through games and a simulation about somebody learning to bank. It's actually quite helpful. The estimated length is 35 minutes, and it is a good supplement to learning further about financial literacy. I think that's really it. Yeah, I think that's really it. Okay, thank you for being you. Have a great day. Make good choices. Stay safe and stay healthy.